Hello, everyone, and welcome back to the Peterson Institute for International Economics for our event today, the rollout of the 24th Geneva Report on the World Economy, Debt, the Eye of the Storm. This is a joint event, I'm proud to say, with the CEPR of the EU and with the International Center for Monetary and Banking Studies. I always get the acronym wrong, I apologize. We have a very distinguished panel to talk about a topical issue. Laurence Boone, Moritz Schulharich, and my colleague Anna Gelpern. This effort, of course, is led and overseen by Ugo Panizza. As I mentioned, the Geneva Report on the World Economy, as many of you know, is a major annual publication, and we've been proud at Peterson to be partnering with CEPR in these events for the last few years. Ugo, perhaps you could say a few words about the series and your colleagues who did this year's report.
Thank you very much, Adam, and thank you very much for always cooperating with us on the Geneva Report. So the Geneva Report is now in its 24th issue. The first issue was in 1999. It was created by Charles Wilcox, who was the previous director of the International Center for Monetary Banking Studies, and I happen to have a copy of the original Geneva Report, which is here. And the title was An Independent and Accountable IMF. So an important question then, still important question now, was authored by Jose de Gregorio, Barry Eichelgreen, Taka Ito, and Charles himself. So this year we focus on that, and we have a great team. Two of the authors are here. I've already mentioned them, Hans and Moritz. The other authors are Alan Taylor from UC Davis, Oscar Yorda from UC Davis and the San Francisco Fed, and Joachim Fels from PINCO. And we always try to have a team that mixes academics, policymakers, and market participants. So this year we also have such a team. But I'll give you back the floor, Adam, so that we can listen from the authors.
Thank you, Ugo. As mentioned, this is always a joint effort, and we can't have all the authors at once. So we're very pleased to have with us today, in the order they'll be speaking, Moritz Schulharich, Laurence Boone, and Anna Gelpern. Please let me just briefly introduce each of these distinguished economists. Laurence has just been named the Deputy Secretary General of the OECD for a 2-year term, where she's been head of the economics department and chief economist for the last 4 years, and where she will continue in that role. She ensures that the department is at the forefront of economic thinking, and we all rely on her team and department at the OECD for the country studies and policy branches, and immensely important public good of the research and tracking they do. She also is the Secretary General's spokesperson on economic issues and is the OECD representative at the deputies meeting of the G20 finance track. Moritz Schulharich is the professor of economics at Sciences Po in Paris, and as well as the University of Bonn, director of the Macro Finance Lab, a principal investigator in the DFG Excellence Cluster Econ Tribute. If you're not a European, you may not understand all these things, but it's a big deal. He works in the fields of macro finance, banking and financial stability, as well as political economy and economic history. Recently, he has been one of the recipients of the 2022 Leibniz Prize, Germany's most important research prize, awarded by the German Science Foundation. That's DFG. He is also the managing editor, one of the managing editors of Economic Policy, one of the other CEPR flagship publications. Joining us after they present the report, my colleague Anna Gelpern, who is a non-resident senior fellow at the Peterson Institute, but professor of law and Anne Fleming research professor at Georgetown University Law Center, will be the discussant. As many of you know, Anna has created, in many ways, the field of macroeconomics and law, as well as doing a huge amount of groundbreaking work on international banking and debt. And she's co-authored the leading law textbook on international finance. And she's consulted for a number of international and government agencies, including most recently as an expert for the UN Conference on Trade and Development. Look, the title of the report, Debt, the Eye of the Storm, tells you most of what they're saying, but it is a profound thing they're saying. They are the authors of this report, in my view, are taking the most balanced, objective view of the state of debt and the risks associated with it coming out of COVID. And there is record high debt, as we're all sick of hearing, but it isn't quite that simple. And so the Geneva report studies the outlook for public, household, and corporate debt, as a special focus on the outlook for the Chinese economy and for inflationary risks. And importantly, as they will explain, this is not just doom and gloom. There are risks, but the simple existence of debt doesn't mean that the risks are the same as they always were. So with that, let me turn it over to Moritz, who I believe will be presenting first.
Thank you for the very kind words, Adam. I hope you can see the screen and we can go ahead. We're very happy today to present the 24th Geneva report here today. This joint work, we can't be said often enough, with Laurence Boone, who is here, Joachim Feltz, Oscar Jordan, and Alan Taylor. Before we get started, let me briefly but very deeply thank the fantastic team at CEPR and at the Geneva Center, who have been just incredible to work with on this report, and also obviously Adam and the team at Peterson, as well as Anna for the discussion and hosting us today. So thank you very much. Our report, Debt, the Eye of the Storm, starts from the observation that, as Adam said, we live in a time of high debt. We have record levels of consumer, households, sovereign, and corporate debt around the world. And we think this high debt will be a key backdrop for policy over the next decade. So the report, the 24th Geneva report on the world economy, explores the economic risks entailed by record levels of debt. There is a clear case that financial vulnerability is endemic in a highly leveraged world. A lot of research over the past decade after the financial crisis has shown how high debt amplifies shocks, how high debt slows down, drags down the economic recovery from recessions. So it is not difficult to be pessimistic about future economic, social, and political stability in a world of record debt levels. On the other hand, we need a deeper understanding of the secular causes that got us here. And here, as was mentioned before by Adam, we try to take a balanced approach. We'll argue that the debt boom is the flip side of the surge in savings in recent decades. It is the flip side of the various savings gluts that have occupied our economic thinking over the past years. And we also argue that the trends behind the oversupplying credit will likely continue for a long time, but that is a key question, how long this macro constellation will last. Let me, as a background, start with the facts. On the left-hand side, you see government, household, and business debt to GDP levels for advanced economies. On the right-hand side, the same data for emerging market economies. And the message here is quite straightforward and clear. Over the past roughly 40 years, debt levels of all sectors in the economy, they have risen sharply. They've surged to somewhere around 300% of GDP in advanced economies and around 250% of GDP in emerging market economies. You also see that the COVID pandemic has led to another surge of roughly 20 percentage points relative to GDP in both emerging and advanced economies. But there's a deeper or longer trend here that we want to pay attention to, that debt levels have been on the rise for quite some time, and the pandemic is the last instance of a sharp increase in debt. So at the same time, and this is an important observation, as debt to GDP has risen so sharply around the world, interest rates, here we're showing the real natural interest rates, often termed R star, have fallen sharply. So the combination of rising volumes, quantities of credit and debt, and the decline of interest rates, in our view, is a strong indicator that credit supply in the global economy has expanded sharply over the past decades. And to give you the intuition in a simple framework, why do we think credit supply, savings supply, is a main factor for the phenomena that we observe, namely at the same time an increase in the quantity of credit and debt in the global economy and a decline in real interest rates? Well, on the left-hand side, you see what happens to interest rates and quantities of credit after a credit supply shock. we get an increase in both of the quantity of credit and a decline in the real interest rates. The alternative explanation for what we see, that we live in an investment dearth, we're not investing enough, is shown on the right side. We would see a decline in real interest rates, but at the same time, we would likely see decreases in the quantity of credit. So the combination of more debt and lower rates is a strong indication and a strong economic rationale to think about the big trends in the global macroeconomy in the past decades through the lens of an increase in savings. Where are these savings coming from? Well, there are various savings floods out there. One that has been debated and discussed quite intensely in recent years is the savings flood of the rich. It is the idea that with rising inequality, more income concentrates in the hands of rich households at the top of the distribution with high propensities to save, with high savings rates. And you see that here in this table where we show the share of total wealth growth coming from savings and from capital gains since 1980 for the G3, for the US, for Europe, and for China. And you can see that for the top 10, both in the United States and in Europe and in China, the dominant share of wealth growth has been new saving. There's just been a lot of income that has concentrated in the hands of the 10%, the richest 10% of households. And with high savings rates, there's been an increase in the supply of savings coming from the rich. You see here that there's also a large propensity of these rich households in the US. Roughly half of all the saving done by the top 10% of households has been done in fixed income securities, which are, if you will, the deposits or the bonds that have financed the debt increase on the other side of the balance sheet. Similar trends in Europe. But that's not the only savings flood that's out there, and they're also interconnected and intertwined in various ways. There's also savings flood of the old out there. The idea here is that with shifts in demographics and an aging population, especially older households have an incentive to save more. And these three charts show you the increase in older households defined here as 45 plus, their asset increases, the total financial assets and the total financial assets of both groups. And you can see that the surge in financial wealth in recent decades has really come from that group of old households, or older households, I should say, over the age of 45, who have accumulated financial assets that are, and we'll get back to this later in the talk, that have supplied the savings for the debt increase of other households. So where does this leave us as a sort of framework to think about the debt boom in recent decades? Well, clearly the global debt boom is the flip side of the surge in gross savings and the increase in financial wealth experienced in recent decades. And if we look at the asset side, not just at the debt side of household balance sheets, then you will find that households have never been wealthier than today, which is a balance sheet. In the balance sheet logic, for every debtor, there has to be a creditor, and for the creditor, the debts of someone else are the asset. So the risk and the discussion, the risk line, the distributions of assets and liabilities from a net wealth perspective, you can look at the world right now and say we've never, on the household side at least, we've never been richer than today. Do we think that the macro constellation underpinning the various savings floods is likely to stay in place? In the report, we think that the answer is broadly yes. The factors underlying the increase in inequality, the demographic forces that have pulled the world or pushed the world into more savings supply are likely to remain with us, and hence we, despite what has been, despite the recent increases at the short end, we think that there's a fundamental case that interest rates would probably stay low. So let me go through the individual, start with the household debt and corporate debt, and then hand over to Laurence. So we go through in the report, we go through the panorama of the various sectors in the economy, starting with households. And on the household side, what we see this, clearly the household debt was the epicenter of financial instability in 2008. And there is out there in the economics community, of course, the idea that what we've seen now in the pandemic might be a replay of what happened earlier, that there's going to be a rebuilding of balance sheets and a drawn out recovery. We think this time is different. Going into the pandemic, household deleveraging has taken place in advanced economies. And if you look at the debt service burden, and also if you look at the interest burden, it's very clear, but also if you look at the total debt service burden, things look much better than they did a decade ago. Household debt trends in emerging markets are more worrying and are a potential source of vulnerability. That is maybe something we can discuss later in the Q&A. To give you a quick two charts here, the household debt to GDP ratio, you can see that in advanced economies, there's been deleveraging in the past decade, and even the increase during the COVID pandemic has been relatively small. In emerging market economies, there's been more of a credit boom in households in the past decade. So household debt to GDP levels have doubled. As I mentioned, that is clearly a source of growing vulnerabilities, but also with an eye on this second chart, the household debt service obligations in percent of disposable income over the past 20 years. You can see we've come down since the financial crisis. We are in an area of like between around 12, 13% in advanced economies and maybe 10, 11% in emerging markets. These are, by historical standards, these are not low levels of household debt service, but they're also off the peaks, and the household side does not raise a lot of red flags at this moment, at least in our analysis. Let me spend a couple of minutes on the corporate debt side. Corporate debts, and especially the colorful zombies that are often invoked, that roam around in the macroeconomy and slow down the recovery. Here too, our report takes a relatively clear stance that we think that worries about corporate debt overhang and zombification are likely overblown. It is true that corporate debt has increased, and there was a corporate debt boom in some, not all countries in the past decade, and the facilities and aid measures taken in the pandemic have pushed corporate debt levels up even further. But the main reason why we are let me say, where we take a more benign view here is that corporate debt booms historically leave very few traces on the macroeconomy if, and that's an important if bankruptcy institutions and are efficient and bank supervisors do their job. So the analogy to household debt, I will show you a chart in just 1 minute, is misleading in the sense that the issues surrounding debt restructuring of over-indebted households are really pervasive and can drag down the spending and by indebted households. On the corporate side, we have well-established institutions to deal with overly levered and overly indebted corporations. So here, 2 quick charts as well before I hand over, soon hand over to Laurence. Corporate debt relative to GDP since 2010, I think there's 2 important messages here. One is there hasn't been a global corporate debt boom. On the contrary, if you look below the line, Italy, even the UK, Germany are countries where the corporate sector has delevered quite strongly since the 2010 crisis, and even with the surge in corporate debt in the pandemic, we're barely at the levels where we were 10, 15 years ago. There are exceptions. There are countries that had witnessed substantial corporate debt booms. First of all, there's China, where we'll talk about this in a minute. That has really seen a spectacular growth of corporate debt, but also household debt and government debt. And the other case is the US, and the other 2 cases are US and France, where corporate debt has increased quite significantly, both before and then, especially in the pandemic. So France is really quite a remarkable case in that regard. But the comfort we take here is that the countries, with the exception potentially of China, I'm going to talk about China in a minute, that the countries that had substantial corporate debt increases in the past decade are also happen to be the countries where we think that bankruptcy institutions and bank supervision work reasonably well. So going by historical evidence, if regulators make sure that banks don't evergreen loans to unprofitable companies, and if the bankruptcy or debt restructuring institutions are allowed to do their job in an efficient way, there's no reason to think that these corporate debt booms will be a burden on growth. And this is shown here because I think it summarizes very well the fears that many have, but also the reason why we are relaxed. On the left-hand side, you see the aftermath of a corporate debt boom. So the change, if you have large increases in corporate debt to GDP in the previous 3 years, to what extent is that correlated with bad macroeconomic outcomes ahead? And you see on the left-hand side for the corporate credit, this is pretty much a straight line. On the right-hand side, exactly the same chart for household credit booms, household debt booms. And here you see a very clear negative relation that also was established in other papers before, but the overall message is very clear. Fear not so much corporate debt. The analogy to the household debt boom and the drag on the recovery that we saw after 2008 might be not the right one. I'm going to just very quickly tell you what happens if we don't restructure the debt, if we don't allow bankruptcy institutions to work efficiently and bank supervisors are incentivized to evergreen loans instead of forcing loss recognition. These are the path of recoveries after severe recessions, where zombie shares really do increase and where there is a drag on growth. So it is important here from a policy perspective, if you're worried about zombification, push for debt reorganization and bank supervision. Okay, I'm going to use my last minute to talk briefly about China and then hand over to Laurence. China is a special case because China's witnessed one of the most spectacular credit booms in modern economic history. There's no question. Debt to GDP more than doubled in the past decade. And we know from research that we've done that such large credit booms typically end in a financial crisis. So do we fear financial crisis in China, which would clearly be a game changer for the global economy going forward? We do not. We think a hot crisis in China can probably be avoided despite that large credit boom. And that is because the government has tight control still of the financial sector. What we think China will not be able to avoid, however, is a severe drag on growth going forward, stemming from the overhang from that large and historically almost unprecedented credit boom in the past decade. Two last charts on the Chinese situation. Here's total social debt in percent of GDP, and you see we've moved from 130% to GDP in 08, 07 to more than close to 300%, so more than a doubling relative to GDP. And keep in mind, Chinese GDP has not been stable, not been constant over that period. So the amount of new credit going into that economy that was growing fast is really enormous. This is the reason why we think a hot crisis is an unlikely outcome. The reason is that if you look at the non-financial corporate debt in China, which, just jumping back one slide, you see has been a big part of the increase here. The households have also leveraged and the government too, but it's been mostly the corporate sector in China. 96% relative to GDP, so the largest, more than half of that, close to 2/3 of that corporate debt is debt of state-owned enterprises. So there is on both sides of the financial system, on the banking side and on the lender side and on the borrower side, the government does have control to make sure that we don't slip into a real hot financial crisis scenario, although a lot of the constellations, the typical macro constellations, is there. That's it from me. Laurence, you want to take over and I'll move along.
Thank you. Thanks. I think Moritz expressed well our thanks to CEPR, Adam, Anna as well for the discussion, Hugo for his advice. And let me add also thank you to our fabulous co-authors who have worked as hard as Moritz, and it was a very nice and sympathetic experience to do this. So thanks again, Hugo, for the opportunity. So I'll look at public debt and inflation, and I'll try to be as efficient as Moritz in the first part. So if we look at public debt today and compare it with 2019, there's no doubt that the median debt to GDP will be rising, and by a very significant amount across OECD countries. And we've done some projection until 2023. And that has, as Moritz explained at the beginning, to do with the fiscal support that government have been providing to firms and people during the COVID-19 pandemic. But as he was saying, this has also to do that it came on top of already high debt level in most OECD countries. And I think that's very striking that over the past decades, we have seen significant jumps associated with recession. And the latest and largest one was the global financial crisis about 10 days ago. And so this is obviously raising some concern, but I think one of the things we show in this chapter, like in the whole book, is it's not this jump in debt due to COVID that's of concern to us. It was necessary and it did well to protect the economy. But what is of concern is how debt may have been managed in the past and the challenges that we are going to see ahead of us. So Moritz has kindly accepted to pass the slide, and I'm very grateful as well. And what you can see here is the first warning that we wanted to say, having this balanced view that Moritz was describing, is really that we are not at the end of the crisis totally. We don't know what will happen, obviously, with the virus, but also what the left-hand side chart shows is that employment level in the OECD have not recovered to what they were before. And by the same token, what the right-hand side serves to show is that we've been successful so far in avoiding to repeat the mistakes of the financial crisis. And so we've been successful in avoiding precipitated or rush consolidation, so that unlike in the financial crisis, investment has sort of hold up as a share of GDP. Even so, you can see that it's not great level of investment. So we're saying this because for us, the challenges, as I was saying, is not the short term, it's what happens in the longer term. So what should be of more concern actually is the factors which will challenge public finances over the medium term. And you know, all of them, they're represented on the left-hand side. It's pension aging, it's for not only population aging, not only for pension and health. It's not only an advanced economy story. This is also an emerging market economy stories. There's about 10-year lag between the two. And adding to this, which is quite well known, what we show here is that if we wanted to offset the rising cost for public finances of aging, we would probably need to increase taxes by about 8% of GDP, which in some cases is very significant amount. But that's just a number to give some idea and to make things a little more concrete. And you know, when people were asked what the COVID crisis will change, the pessimistic in me were thinking not much, but in fact, it was being too pessimistic, because one of the main change is actually the awareness about climate change and the commitment of many countries around the globe to address climate change. And climate change will have a large impact on public finances. Research here is really at its infancy, but what the right-hand side chart shows is what the OBR, the UK Office for Budget Responsibility, has estimated climate change could actually do to public finances. So in a nutshell, you have rising carbon tax receipts, but at the same time, declining fossil fuel tax revenues, and they're usually sizable. And there's a need for big investment, as you know. And because the world has become a little more pessimistic about climate change, we tend to think that you know, rising carbon taxes and rising investment needs will actually weigh on growth looking forward. So all this in this OBR calculation brings an estimate that brings a result that the public debt in the UK would rise by about 20% point of GDP, which is very sizable when we look at the level of debt already. Obviously, it all depends when you start fighting. It's okay, Moritz, fighting climate action. We can, thank you. Here, I won't spend too much time. I think Moritz has been really clear about interest rates. So let me push that on the side, but perhaps explain a little more why we think lower interest rates than what we had seen prior to 2000 may persist. And this is explained on the right-hand side with a paper from Rachel, Lucas, and Smith, where they were trying in 2015 to actually provide both estimates of the main channels that could explain the decline or the secular decline in interest rates. Moritz has mentioned one of the biggest one, which is higher savings by older population, and also inequalities with the saving glut of the rich, as he was saying. There's also the demand for safe assets, which followed the great financial crisis. And all this is unlikely to revert. So we think that for the foreseeable future, these forces are likely to dominate, even if there's a lot of uncertainty. We don't deny that. And in fact, Goodhart, in commenting on the report, highlighted that it could actually be the opposite, that aging could actually push rate higher because of inflation. But I think the main point is, so far, we think evidence is tilted in that direction. Even so, uncertainty should leave us cautious. Perhaps we can move to the next one. Okay. Now, all this setup was really to explain that we're not, as Maurice explained very well, this is high data is a macro picture that we stay with us for quite a long time. And the short term is not that much worrying. What we think we should be paying attention is really how debt will be managed in the future, and ensure that this management will actually address the priorities of the people in a balanced way, and in such a way that, in fact, tax collection will help to match this spending. So we spend quite a fair amount of time dedicated to governance of public finances rather than to the level of debt per se. What the left-hand side helps to show is that if the government actually does reform to increase growth, and that's on top of the investment that is needed for climate change, but also things like education or health, and a lot of vulnerabilities, current vulnerabilities that the crisis has emphasized, then if these issues are addressed, then we'll have higher growth, and this higher growth will actually decrease the pressure on public finances. And it is very key, and this is why we look at fiscal governance, and that I think is my last slide, or the one before last, before I move to inflation. What's really key is the credibility of government and institutions in doing that. I mean, the best example is obviously to ask oneself, well, why does Japan, with such high debt level, debt to GDP ratio, has no fiscal sustainability issue, whereas another country with 35%, for example, of debt to GDP ratio has much more trouble. And we really think that has to do with policies and institutions. So I've touched upon policies on the left-hand side, and I think we should think hard about institutions on the right-hand side. And that's why we talk about independent fiscal institutions. So they are not here to substitute to government. It's not like monetary policy. Fiscal policy is the profound expression of democracy, so that cannot happen. But it's about arguing for institutions which can shed light on the public finances debate, which is by nature very complex. So they can actually explain the projections, what that means, not only for debt or GDP, but also for inequality and the distribution of revenue. And Maurice was mentioning earlier that, in fact, this is about distributional issue, and this is even more the case for public finances. So they can shed light, they can help make choices and priorities, and we think that's very important. And the strength of this institution, and I'm sure Anna will talk about this as well, can actually make higher debt to GDP level sustainable for longer. And with this, I think I should be moving for inflation, as I must already be out of time. So if you can bear with me for a couple of minutes. One of the things we really wanted to address in the report is always all this debt going to create inflation, which is something that we hear a lot. And obviously, with some of the numbers today, the topic is back on the table. So let me just give a bit of a framework to think about this. I think we all agree that inflation will depend on expectation and cyclical pressure. And in principle, once cyclical pressure fades, then inflation goes back to expectation, which today, as you can see from the chart, are quite well anchored about central bank targets, even if they're higher than in the previous decade where they were too low. So there are three narratives, roughly, linking inflation to high fiscal deficit and rising public debt. The first one is that large fiscal stimulus program amplify cyclical pressure, and Adam has held here many seminars about this in the course of the COVID crisis. The second one is that QE may raise the risk of fiscal dominance because high debt level would constrain central bank ability to tighten monetary policy if inflation was getting too high. And the third one is about the private sector starting to believe that, there will be free money for all the time and the government will not actually stabilize or reining, come back on the fiscal stimulus that was provided before, and that's obviously fueling cyclical pressure. So I think we cannot really deny that strong fiscal support coupled with supply chain disruptions, and that's important, and high energy and food prices have pushed prices in many, but not all, and I think that's important part of the world. In Asia, you don't have inflation concern today. But I also say, and we also share the view that three things mitigate this. The first one is that the large fiscal stimulus program from COVID are actually behind us. This is true in the US, and it's true in many countries where the fiscal support is being withdrawn, at least what was temporarily targeted at households and corporate, which Moritz was showing. So that's fading away. And as I mentioned before, there's still a lot of labor market slack on aggregate. So for that's the first thing, saying that one of the pressure is moving away. The second is, I think, the credibility of the fiscal framework I was mentioning, and public finance management is key. And what we are seeing is that in many countries, the rise in debt or the experience of past crises linked to sovereign debt as well, for example, in emerging market economies, that's actually creating pressure to adjust fiscal policy. And even though R-G is giving some breathing space, we are seeing governments moving. And we wouldn't want governments to move too quickly on consolidation, because what they need most is to redirect spending towards investment, but not necessarily consolidate fast. And the last point, I think, which is important, is when we doubt that central banks will be able to tighten monetary policy, I think we've seen over the past months ample evidence that this is not happening. And in fact, we are seeing many central banks across the globe starting to remove the accommodative side of their monetary policy, and we haven't seen the anchoring on inflation. And in concluding for inflation, I would say that actually, if there's one thing we should pay attention on, is still not to withdraw the fiscal and monetary support too quickly, to pay attention to the composition of fiscal spending and redirect them. And also the balance of fiscal and monetary policy have played a role in this temporary pressure, cyclical pressure, and both levers will probably be important in smoothing some of this temporary pressure. So not team temporary, but long-term trend suggests that we should not see a repeat of the same.
Laurence, I have to ask you to wrap up, please.
That's it.
Okay, Anna, over to you.
So, Adam, thank you, and thank you to Moritz and Laurence and to Ugo for inviting me to be a part of this conversation. it's a huge honor as a longtime consumer of the Geneva reports. I'm tickled to be here. Now, because I am not an economist, I'm a lawyer. By definition, I'll have a somewhat different perspective on some of the conversation. And I'm a little bit peeved that it is my job to be critical in the response because, you know, if you guys are saying the panic is overblown, isn't kind of the ritual thing for me to say, well, no, we still have to panic about this and that. So I'm going to try to use your model of balance and not do that. I am just absolutely thrilled at the perspective that you're presenting here, and that is that, look, just the fact that debt levels are high, stocks are high, is sort of meaningless. It's, you know, it's like the debt clocks that, you know, have been popular at various times like this. It's a big number. It's a number that's too big for anybody to wrap their head around, and therefore sort of, the implication is we should panic. Well, probably not. I think that that's exactly right. And I will blame Ugo for invoking Hamilton. And the idea is, and I think this is something that you do really well in this report, is look, debt is an institution with constituents. Debt is a political institution. Now I'm going beyond the report, that, you know, binds citizens together, binds, you know, elites together. And I think that is an important thing to keep in mind as we consider the institutional context in which this debt accumulation and debt management occurs, as Laurence just said. So I really welcome the focus not just on the debtors, but also on who the creditors are. And the fact that you're kind of enriching the savings glut story when you're talking about the old, the rich, and the foreign, right? And I'll come back to that momentarily. And in China's case, of course, it is the domestic, but here also, I think the subtlety of the discussion, the balance of that, look, under some circumstances, the fact that all your debt is in domestic regulated or, you know, owned institutions is actually not a terrible thing in the middle of a crisis. It may not be a, you know, the most efficient way to run the world, but it certainly is a mitigating factor in the when you consider Chinese debt. I do think that that is all right on. But then I ask, you know, I want to look at some of the assumptions that you're highlighting, and again, rightly so. A debt crisis is a massive redistribution event, right? And when you know, I think about the old, the rich, and the foreign, that's kind of the stuff of revolutions, right? I mean, it was in the first report. You know, so the pensioners and the foreigners are the very constituents that we talk about in the middle of debt crises when institutions are under stress. So I do think that it is both, it's short-term heartening and medium-term slightly disconcerting that that is who the creditors are. Ultimately, at least, but I also think that the mediating institutions are important. So some of the institutional assumptions in the report, I think, are critical and bear watching. You know, of course, you've talked a lot about the central banks, both that they're going to do their monetary policy job, but also that they're big holders of the debt, right? And that is something certainly to watch. The assumption that they're going to manage this smoothly is one that I hope holds up. The safety of safe assets, again, is something that is another institutional assumption, and the trouble is that it tends to be binary. They're safe until they're not. So not just the the interest rates on safe assets that are in everybody's savings, but also the very nature of those assets, the construction of them, the kind of legal and institutional context that makes them safe. I won't, linger on the financial sector, which I think is refreshingly not front and center here. But of course, the fact that it is well capitalized and it works as it should is another important assumption. Bankruptcy laws, the big if that Moritz mentioned. And I'll add resolution here, since I mentioned financial institutions. It is true that we haven't seen a giant spike in bankruptcies, but of course the past 2 years have sort of been not been a very good testing ground, because it's been a period of suspended animation, right? I mean, it's for various reasons in different countries, we really haven't tested whether the bankruptcy regimes are up to the task. We haven't had to. And that's where past history is not encouraging. So really, we're not just relying on the fact that bankruptcy institutions will perform well at scale, but the implication here is that they will perform way better than they ever have at scale, right? There hasn't been a crisis where bankruptcy regimes haven't been tweaked, suspended, or upended in the past. And here I want to just come back for 1 second to this question of debt on central bank balance sheets. I don't think we've had to grapple with it again at this scale. And look, my hope and my trust is that it will work out. But the biggest holdout in the Greek restructuring was not a hedge fund, right? And that gives me pause. Climate concerns, I think, are properly front and center. And I totally agree that the fact that the climate consensus is moving is in the right direction is wonderful. But I think that, again, the institutions, the contracts, the instruments that channel resources for climate mitigation and adaptation purposes are not really tested. And I would love to be certain that all of this investment, in fact, is working as it should. I am not entirely convinced. So to wrap up, some of the things that I would love to see discussed a bit more are, it's not surprising, the interconnectedness, the concentrations, the dynamics in the system that you're describing. The fact that, we have significant information gaps and the debt in China is important, but of course, the extent to which that impacts China's behavior and the behavior of Chinese institutions as creditors elsewhere in the world, I think is important and bears watching. Trouble often starts in small, obscure corners that nobody thinks are systemic. The US subprime housing market comes to mind. So I do think that, again, the ways in which this can reverberate bears watching. Finally, Laurence, one of your last points about about international architecture and international financial institutions, and this is an important assumption that I think we need to work hard to bolster, that cooperation will work, that we will speak the same language and broadly be guided by the same set of coherent objectives. At least in the public debt space, I'm not quite as confident as I would like to be. But look, your report says the roof is not leaking. That's great. Let's just make sure to do the maintenance work and the construction work that it takes to make sure that it can withstand what storms might come and remain as hopeful as you suggest we should be. Thank you.
Thank you very much, Anna. Moritz, Laurence, it's very fascinating, and Anna is always very provocative. We have a great set of questions from our very large online audience, and so I'd like to get to some of those right away, given the limited time remaining. Let me start with a question from Bernard Casey. What are the implications for China if the government exercises its option that's clamped down on corporate debt? Or is it that China won't move? Could you just expand a bit more on how you see the Chinese debt situation, since you did cover that briefly in the presentation?
I'm happy to go ahead, Laurence, if you want to take your turn first. I think the framework we think about the Chinese situation is the following. There is, by historical standards, what has happened there in the past decade. Let me put it this way: it would be a miracle if that capital allocation has been efficient, and there wouldn't be bad debts hadn't been piled up, given the enormous mobilization of resources and quantities of credit that we've seen. So what we know from sort of the academic literature is that these debt booms typically are a precursor of financial crises. At some point, markets panic, markets realize not all of these debts will be paid back. There's some liquidity squeeze, people run through the same door, depressing prices even more, and we get into some crisis situation. That's what we call a hot crisis. And we think that hot crisis scenario, where investors, creditors stampede through the door at the same time, where asset prices fall, leverage rises because of the decline in prices, etc., that scenario seems one that is, at the moment at least, quite distant, given that both on the creditor and the debtor side, it's sort of the same entity, namely the government to a large degree, that can prevent these panic dynamics from taking hold. I think that's really our argument from the macro side. What we also acknowledge very clearly is that even if you don't have these panic dynamics, and there's a very nice recent paper actually on this by Matt Barron and Emil Werner and co-authors, even if you don't have these panic dynamics, the credit booms still have measurable consequences on the macroeconomy when the party is over. And this drag on growth, the restructuring, the reset in expectations. Think about all these loans that have been given out in China with the expectation of 7% growth forever. Some of these loans will not be serviced. They will go bad. Expectations will reset. Things will be much less boomy over there. So the growth drag will still be there. And we think probably even, that's my opinion. I'm not sure where the OECD forecast is, but I think we might well be in a scenario where current growth forecast for China will turn out to be optimistic. At least that's what past experience would tell us.
Thank you, Moritz. Let me now turn to a question from Kathleen Stevenson. Doesn't the savings glut stemming from high income savings perpetuate inequality as low income borrowers spend a rising portion of income toward debt servicing? And in general, we know that Atif Mian and others have spoken about the importance of distributional aspects of the savings glut. I know others on the co-authors of yours also have worked on this. So Laurence or Moritz or Anna, any comments on this issue?
I'll let Moritz talk about this because he's mentioned it in the introduction, and I took more time than him. We're rebalancing, it's average inflation.
Fine, so if you're rebalancing, then Moritz, go.
I do agree. I do agree that to some degree these dynamics are self-reinforcing through the higher capital income that savers at the top of the distribution can get in capital markets. I think what we want to draw attention to in the report is just the fact that these trends are not likely to reverse anytime soon. There's, I think, an argument that can be made that if you think about the potential, I think the factor that would change the picture that we're drawing a lot is if for some reason real interest rates would increase significantly over the next decade. Through a reversal of policies, through a reversal of inequality policies, if we redistribute more, or if, as Anna, and by the way, thank you very much for that amazing discussion, as Anna alluded to, if these debtor-creditor conflicts, they're distributional in the end, and if we turn more against the pensioners and say like, okay, we have to do something for the younger generations here, if any of these trends push up real interest rates in the next decade, and I think we're in a very different world. But this is the point I wanted to make at the beginning is, given high debt levels, it is really hard to see higher real interest rates not taking a toll on the economy, because exactly the households that like to spend, that have high propensities to consume, those are the debtor households, they're the impatient ones. And if rates rise and their debt service burden goes up, we lose an important source of demand. So there's an equilibrium force here at work as well, where I would say probably rates can't go up too high before we see a drag on growth.
Thank you. I have a question from Joseph Gagnon about the global capital flows and aspect of the savings glut. Are you worried about some countries free riding on expansionary fiscal policy and their trading partners to support growth in the face of adverse shocks like COVID? Do we need global coordination to offset the negative externality of spillovers that reduce the benefits of fiscal stimulus for the country undertaking it? And likewise, to discourage those that intervene to hold their currencies down and grab a larger share of exports. Many of you will recognize this is related to work that Joe and Fred Bergsten and others at the Institute have done through the years. But that doesn't mean it's not still a live question. So, Laurence?
Okay, I take it over. Effectively, if you talk about global saving gluts, then you have to talk about global coordination of fiscal policy, which is exactly what you were alluding to, Adam, reading this question. Let me say two things on this. The first one is it would make life easier for the global economy if that was happening. And we had a very strong example of this, two very strong examples. One in 2009 during the London G20, when this coordination of fiscal policy really put some halt to the downward spiral of the economy. Same thing, by the way, when the European Union announced Next Generation EU, right? That gives fiscal space and help rebalance some of the disequilibrium. And we had the issue of China in that respect. The second thing, which I think is important, is if we had this sort of fiscal coordination, not only for investment, then that would probably allow, with the size of the multiplier being inflated, to do a little less and to consolidate the perception of investors and the creditors that Anna was talking about. And thanks, Anna.
Thank you for your concision, Laurence, on a very complicated topic. We've received several questions which are variants on how much is accommodative monetary policy or easy monetary policy cause of debt growth. I've long tried to push back against this. In my view, the issue is the monetary policy ease is a reaction to the savings glut, is a reaction to the low rates rather than a cause. But the others seem to repeatedly want to place causal primacy, if not blame, on accommodative monetary policy. How do you all see that issue?
I can make one point. I don't think I see monetary policy as an enabler of fiscal policy, but not a cause of the fiscal policy. I agree with what you were saying. We're doing an exercise. If you look at demand since pre-COVID and the trend it had pre-COVID crisis, and you look at where it is today in the various G20 economies, you will realize that there are only 2 or 3 economies where demand is back to pre-crisis trends. And that does suggest there hasn't been a huge stimulus of demand, neither on the monetary side and in many instances on the fiscal side, but probably something that was appropriate. I'm sure Maurice wants to add.
I would say I'm 80% your way, Adam, and maybe 20%. I would say there is an asymmetry in central bank policy regarding credit booms and exuberant financial conditions, which is the famous mopping up after the party. And I think that may play a role in the encouragement of risk taking and in the expectation of especially macro risk taking by financial intermediaries in in markets that central banks ensure, like housing markets, where we've seen such a strong growth of mortgage lending. So I think there's a little bit of that, but 80% of that is a decline in natural rates, and central banks are just responding to that and not causing that.
Terrific. Thank you all very much. There was so much more in this report, as well as the presentations and Anna Galpern's discussion than we could cover. Thanks to our global audience for engaging and for providing us with thoughtful questions to provoke the authors further. I recommend to everyone to download the 24th Geneva Report on the World Economy, which is available on voxeu.org. And I believe we also have a link on the website of the Peterson Institute event, which is now up. And with that, I just thank again Anna Galpern, Moritz Schullerich, Lawrence Boone, Ugo Panizza, and congratulate you and your co-authors on another important, independent thinking, empirically based report, and thanking the CEPR for continuing to partner with PIIE in getting this work out to a broad audience. This meeting is adjourned.
Thank you very much.